Thank you, everyone, for joining us for this Transform Finance Investor Network webinar today. My name is Andrea Armeni, and I will be joined today by Nathan Schneider and by Jason Wiener to talk about democratized tech and distributed ownership as an exit strategy. We'll be covering, as you will see, some of the topics that we've been looking at for the last while in a few different incarnations. First, I wanted to give you a very quick couple of Investor Network member updates on our part as Transform Finance. Yesterday, we released the briefing, the investor briefing that we've discussed with you previously on renewable energy and community engagement, looking at the investor role in renewable energy projects and ensuring that communities benefit from those projects, and also how to avoid the risks that come with land disputes, human rights violations, and the like. If you're interested in that, you will find it on our website at transformfinance.org under Investor Resources, and I encourage you to take a look at it if you're interested in the intersection of renewable energy and human rights, and feel free to get back to us with comments on that. Definitely a very salient topic right now. And then I wanted to turn it over to Bruce Campbell, our member from Blue Dot Advocates, for a couple of interesting updates on his end. Thanks for joining us, Bruce.
Andrea? Oh, now I've lost. Hello?
Yes, we can hear you, Bruce. Hi.
Okay, great. Thank you. Hi, everyone. So two updates, and actually both are relevant to our friend Jason, who's joining us, so I think it's appropriate to be doing them at this session. One is that I think as some of you know, we've talked about this before in this forum, but our law firm, along with others, including now Jason, have been working on this project called the Impact Terms Project, and this is a project which catalogs term sheet language and structures related to direct impact investments, and it includes sample term sheets both related to different financial structures that we see people using in impact investments, as well as mission or impact-related terms. And Jason is one of our most recent collaborators who's helping us to develop some content related to investing in cooperatives. And the update there, we're in the process of continuing to raise funding to be able to further improve the website, as well as hire someone who would be a full-time resource to curate the site. And we're also continuing, while we're in the process of finding that additional support, we are continuing to update the content. And one request there would be if people go on the site, it's impactterms.org, two T's, and there is a comment feature where it's possible for anyone to add a comment to the site. I think so far I'm the only one who has commented on the site, and but would appreciate if others could sort of join in that process. And it's just a way for people to identify their own or share their own experiences with the content on the site. And the other update, again, was Jason is helping us with our law firm is in the process of reorganizing as both a workers' cooperative and benefit corporation. Colorado, I think, maybe the only state in the country where it is actually to both have this statutory form of a benefit corporation and a workers' cooperative. So we are in the process of doing that, again, with Jason's help. So that's it for me. Thanks.
Wonderful. Thank you very much, Bruce. And if people want to get in touch with you on either of those topics, how can they reach you?
It's bruce@bluedotlaw.com.
Great. Fantastic. Thank you. So let's turn now to the meat of this of today's webinar that I see as really sitting at the convergence of three of the topics that we've been covering for a while now. One is the issue of alternative deal structures and exits. looking at mission preservation as well as a better alignment of the incentives for all the stakeholders. Platform value extraction, which we looked at recently in the case of the Josephine webinar, probably a couple of months ago or so, looking at where the value is accrued from platforms, from tech platforms in that case, and whether they are serving a role mainly of charging rent seeking, really, and sort of getting a payment every time that they that somebody goes through that platform rather than adding continued value there. And the third is this idea of distributed ownership and how we can create a little bit more of opportunities to asset build. So going through them in turn, with respect to the alternative deal structures and exits, we're looking for both ways to fund ex ante projects and enterprises in ways that are more aligned, and as we'll be exploring mainly today with Nathan and with Jason, how you can have this mission-aligned exits even where the original structure was perhaps conventional, but is the exit that is going to be an alternative structure. And lastly, this idea of, as we always talk about aligning the incentives for everybody, being mindful also of the investor needs, in particular around liquidity and how this liquidity can be obtained without violating mission preservation. So that part fits within the alternative deal structure work. Secondly, we have been talking about this role that platforms are playing increasingly and how that fits very much in real world concerns about access to information, the control and the flow of a lot of the algorithms that affect our daily life. Who gets to benefit from those platforms, right? Are they extracting or are they creating value? And specifically with respect to the investor context, what are the consequences for these platforms of having the expectations of investor return, especially at the venture capital level and the private equity level, being at the core of the decisions about how the algorithm works? So is it really the optimal outcome when algorithmic decisions are being made based on investor expectations rather than the service that is being provided? And you can think of that in terms of, say, a platform such as Twitter or Facebook maximizing for ad revenue rather than maximizing for levels of engagement. Lastly, on the piece of distributed ownership, I think that platform co-ops are really an additional tool that we have for creating more models that can lead to shared asset building. And conversely, they can also be an additional tool in the universe of cooperative distributed ownership besides the worker co-ops that we've covered a couple of times before. Last thing that I will mention is the issue around Juno. I don't know if many of you are familiar with Juno. It was touted for quite a while as this anti-Uber startup, in part because it had created a restricted stock unit program for its drivers at some point last year. And in the context of its acquisition by Get, that I believe was announced yesterday for $200 million, Juno recanted on that offer to the drivers. So that was one instance where it had been praised by a lot of the folks that seem to think that the type of ride-hailing platform such as Uber that can be problematic in many ways could be made less problematic by having the drivers sharing the upside of the platform, and that apparently has been taken away. And again, part of that fits into the context of how these entities are being structured in the first place. Jason was mentioning to me earlier the fact that Kickstarter has now filed to be a Delaware public benefit corporation, which you can think of in some ways as a poison pill almost to ensure that the mission that is deeply at the core of Kickstarter would be preserved in the case of a potential takeover or a potential acquisition of Kickstarter. So how does this all fit in? It touches really on all three of the transformative finance principles. the idea of deep community engagement in design, governance, and ownership, the non-extractiveness of the value that is being created, and the fair allocation of the risks and the returns among the shareholders. And I will turn it over now to Jason and to Nathan to see how we can take these very high-level principles and land them into very concrete structures that that investors can take advantage of in order to foster these principles. Jason, thank you very much for joining us. I'm delighted to have you with us. Well, Nathan actually will go first. Sorry.
Okay. Well, I'll just get us started really briefly, and thank you all for joining us. Thank you for Andrea for your welcome and your support in this. What we want to share with you today is a set of ideas that we've been working on that are designed to try to connect cooperative business models, in some cases cooperative capital sources, with some of the existing tech and startup ecosystem. So, you know, in the development of conversations around platform cooperativism, there have been a lot of people drawn in by the cooperative ideas, but we're trying to figure out how to bring cooperative models to places where they're not currently on offer, and to give founders and investors a wider range of options that in turn can lead to better social outcomes for the tech economy. And so this presentation is really just an attempt to share with you all some of the things that we're thinking about, and to learn from you all about what kind of ideas these in turn raise for you. And we're really looking forward to your feedback, because this is a work in progress, and we're still very much developing it. Who are we anyway? I'll let Jason introduce himself.
Good afternoon, everyone. My name is Jason Weiner. I'm an attorney working at the intersection of social enterprise, distributed ownership, and alternative democratized finance. I run a boutique law practice in Boulder, Colorado. I'm also the co-founder of a regional cooperative development effort with another co-op lawyer here in the Colorado area. I've been practicing with cooperatives for about 8 years. I was in-house at a worker-owned cooperative here in Boulder, and I work at the intersection of a lot of these issues, and I'm excited to be here today to share some of our thinking and engage with you in a strategic effort to mainstream some of the more esoteric concepts that have been talked about before, and try to land them in some practical models and action steps.
Great, thank you. And for about 2 years, I'm Nathan Schneider. For about 2 years, I've been a scholar in residence of media studies at the University of Colorado Boulder. And one of the things that really made me thrilled to arrive here, to move out here from New York, where I was before, was meeting Jason and finding that Boulder was home to one of the most innovative co-op lawyers around right now. And so this presentation is a result of the conversations and collaborations that we've been developing since then. I'm really a journalist by training and by trade, and that work led me into the development of this movement of platform cooperativism. I was a co-organizer with Trevor Schultz of the New School in New York of the original Platform Cooperativism conference in New York City, and that was in 2015. We had another one last year, and we're now organizing the third for this November, also at the New School. We also put out a collective manifesto that we co-edited called Ours to Hack and to Own, that was kind of a reflection of the first conference. And I'm also I've developed the Internet of Ownership directory of the platform cooperative ecosystem. I might continue with a few words about what platform cooperativism is. In a way, it's sort of what it sounds like. It's smushing together the platform economy, an economy of online platforms that are mainly producing value by connecting people and by unlocking the value that those connections provide. And the old cooperative legacy, democratic businesses that are owned and governed by the people that are most dependent on them. And in the online economy, this can take many forms. It can take forms like Stocks United, which we'll talk about a bit later, Stock Photo Cooperative, owned largely by its photographers, but also its employees and others, freelancer cooperatives like Loconomics. So we've got a whole family of startups underway around the world, and then also we're talking about some big ideas about conversions. We currently have a shareholder proposal in for this month's or next month's shareholder meeting at Twitter to explore options for conversion. So the conversation that we're having today is, I think, going to be mainly focused on that question of startups. But we also think that there's relevance here for the future of some of the big established platforms that many of us depend on so much. So Jason can tell us a bit more. I'll say a few things about what how we articulate the problem. Mainly, it is that the internet economy needs better options, and that's all players in the economy, the users, the investors, the entrepreneurs. I can't tell you how many times I've talked to successful founders who kind of quietly tell me, even though their companies have done really well, that they wish they had better options when they were getting going, that they didn't realize how much the current investment offerings tend to force them into situations that they wish they didn't have to go into. It's also resulted in a situation where the dominant platforms are built on surveillance and monopoly, where the interests of investors are kind of at odds with the interests of users. Investor expectations have further decentralized centralized the network, that should say centralized, where investors have demanded and expected this kind of economy of surveillance and monopoly. And the problems really start early on. They start with the ways that we get these companies going in the first place, and there's a lot of path dependency that emerges, and it makes it very hard to consider other options once a company gets going and once it becomes a kind of public utility. And we see these problems manifest for users and issues like fake news, hate speech, bullying, and also a kind of declining worker standards when these platforms engage with investment or with employment, and a dependence on surveillance whose consequences we're still starting to discover. We're still starting to still have a lot to learn about what it means that Google and Facebook and companies like this know so much about us. And I think as we discover the consequences of this, the need for shared ownership is going to become all the more apparent.
So we're talking about the conversion circumstance, or the case of an existing concern. There's, I think, a rich ecosystem that has emerged in the last 5 or so years. The startup scene is quite rich with examples of multi-stakeholder or cooperatively owned business startups. But here we're talking really about a strategic play to look at value that's locked into current investments, current funds, and current ecosystems, whether they be spinouts or cohort participants in accelerators or incubators. And our thesis is this, that companies in a given VC or other portfolio might by any reasonable standard look like a successful business, but due to the expectations of the early stage investors, the concept Nathan talked about earlier, some of those path-dependent terms might have set the business up for success only if it leads to a 10 to 100x liquidity event in, say, 3 to 7 years. And we know that that unicorn story is really a lottery shot. And if we're looking at a success rate of 1 out of every 10 ventures, either IPOing, going public, or being sold in a strategic buyout to a larger business, that may be a definition of success for a strategic investor or venture capital fund, but may leave behind a number of legitimate, viable businesses, particularly ones that may be run and generate value for users, for workers, for other stakeholders. So our thesis is that there are portfolio companies in existing investment portfolios that either don't need subsequent financing, they may not go through a Series B, Series C. We're starting to see all kinds of crazy late round extensions, Series GG, but are actually cash flowing on their own. And so they're not going to need subsequent financing, and as a concern that's generating sufficient cash flow to sustain operations, again, may not look like the kind of exit candidate that a traditional VC fund is looking for. They may be operating profitably, in which case, again, there's no need for subsequent financing. They may also not desire or need access to public markets. And so if at the time of that portfolio company's operations, profitability might simply be all that's desired. So if there's not a likely IPO or acquisition, what then for the investor? If it's a convertible note, if it's an early stage preferred stock investment, what then? So our question is, and this is really an open question, what percentage of a convertible note portfolio fits this definition, fits this profile? We suspect that number is greater than 0. It may not be a substantial percentage, but if we can attempt to restructure an existing percentage of portfolio companies that may be viewed as a dustbin percentage on a VC fund's portfolio, we're talking about something real, some real value to unlock. We're also looking at the types of portfolio companies that have no strategic buyer. Perhaps it's a niche market, or the market that has shifted or that the portfolio company has evolved into just isn't of value to the Googles, Facebooks, and big buyers in the market today, but again, serves as strategic value on a use basis for stakeholders and users, and certainly employees and workers. Lastly, we're also looking at those portfolio companies that might be slightly more mature and might be ready for an exit, but might again be ready for an exit that looks a little different than either a part sell-off or one of the other forms of liquidity. So we're talking about existing tech pipelines of investment, and existing pipelines of company growth. Next slide, please. Nathan, I think you're going to take this one.
We're exploring the potential for co-ops to step in here and be a kind of strategic buyer that hasn't been recognized. And part of that is recognizing the value that cooperative models might be able to bring. When I talked about that surveillance economy earlier, that's kind of predicated on a certain way of viewing the value of a platform's users, that the value is the data is in the data that that can be extracted from those users without scaring them too much, which is often the kind of business model that we've seen. And what we're losing is the potential for those users to buy into the company, to lend value to the company through their trust, through their participation, through the transparency that co-ownership might allow. Rather than hiding your business model from the users, you're able to present it to them more directly, and there may be forms of value here that are not being are not being captured in the current tech economy because of the way it's been funded, organized, and owned. And so we see potential for co-ops to, in certain cases, to provide sustainable exits for certain kinds of companies, and that through that sustainable business model, there could be a return for the investors who put bets on the company early on, and the goal here is to find that spot where the cooperative ownership models can enable a decent return, something better than the investors might be able to get otherwise in seeking other more conventional forms of exit. And so we'll look at some examples of what we're talking about just to concretize this. But what the basic overview is identifying candidates and fund portfolios that might be suitable for co-op conversions, identify co-op capital partners who could come in and finance a buyout with exit to future co-owners. So we're not expecting the traditional tech finance folks to necessarily become overnight experts in cooperative finance. We want to draw in existing experts in cooperative finance. So we're talking to people like the Working World, which specializes in worker cooperatives. We would like to approach partners like large mutual insurers and cooperative banks that are more familiar with financing cooperative models, and then the new co-owners, those also private equity firms could play a role here. The new co-owners, the users in many cases, would then pay off the bridge capital from those co-op financing agencies with revenue from the business.
So if I can jump in for just 1 second there before we get into the details of the terms, I just wanted to emphasize what Nathan was saying. This actually solves a problem for the investors as well, right? It's not just on the social side that we've been covering so far. This flips the equation a little bit and is emphasizing also the how this can solve one of the problems for the early VC investors, which I think is a very creative twist on it.
Yeah, Andrea, that's quite interesting. That was certainly our approach. We were looking at concocting or at least hypothesizing that there was a problem in the traditional VC model, and one that we could approach a traditional VC firm and get them to think about. And that's where we came up with the hypothesis that there's some percentage of deals in their pipeline or in their fund that are not good liquidity exits, and if we can offer them something better than a complete write-off, that we could get their attention.
Yeah, and
so we're
again, just one last thing, sorry, for those that have been on these calls for a while now, you might remember that a while back we were exploring this idea of using private equity as a vehicle for fostering more conversions of exiting owners of closely held companies to their employees in the way that New Belgium Brewery has done or Just Pickles. And similarly here, there is this idea of having this kind of in between vehicle, and it would be interesting to see what of Jason and Nathan's work could be applied also to that idea of that interim private equity step. Again, just a little inside baseball for the ones that have been looking at these issues with us for a while. Thanks, sorry.
No, thank you. We're going to talk about the private equity example as the second here. So we wanted to make this as real as possible and walk through some hypotheticals to kind of draw out what the steps might look like. And so in example one, we're talking about a direct buyout scenario. This is, again, using my hypothesis, an existing portfolio company of, say, a traditional early stage venture capital fund, and they've got steady cash flow and a vibrant user community. The founder in this case doesn't want to raise additional capital in a qualified financing. And for those of you who are familiar with or have invested in convertible notes without a qualified financing, there's little to no likelihood of that convertible note ever converting into preferred stock down down the road. And so funds are in a quandary to either extend the term of the convertible note, seeing no liquidity until that note is either paid off or converts, or they can push on the venture to seek an IPO or go through qualified financing. But in this case, we'll posit the founder doesn't see a need for that, doesn't want that, and so the fund is forced to essentially extend their note indefinitely. And I've heard time and again that a good number of deals for early stage VCs end up doing this, and it can be years of note extensions with no liquidity. So those are our targets. So in this case, we're calling this Portco for portfolio company. And the steps when it comes time for a founder to seek an exit and a way to provide, again, kind of a solution to the VC to give them the liquidity or some liquidity that they need and are looking for. Again, we'll posit the founder at this point is seeking an exit or at least a restructuring of the equity to maybe get the VC fund off his balance sheet, or the founder is looking at an exit for some other reason. Here, there's essentially an enterprise valuation negotiation. We're talking about a slightly different setup, and so the traditional metrics for valuation are all negotiable and flexible. But here, the end goal is a buyout of the controlling interest of the entity for the benefit of users, workers, contributors. In this case, we're using the most inclusive, broad scenario, the multi-stakeholder cooperative, so that we can extend and distribute benefits among the greatest array of stakeholders, workers, users, and contributors. As Nathan highlighted in our model, we pay off the early stage investors with, well, in this case, we're not going to have, we don't need to do a cash out. We would be paying off the fund with preferred stock. And in this case, we're talking about a cash flowing business with profitability. And so that preferred stock might yield a target dividend, which is something you've probably talked about in a prior webinar. It's a model that's borrowed from the likes of Equal Exchange, Namaste Solar, where the preferred stock is not capital appreciating stock, but rather dividend bearing stock. And again, in a scenario where a VC fund is looking at a complete write-down or some zero rate of return, this might be attractive on a case-by-case basis. Another key differentiating feature to a multi-stakeholder cooperative is that profits are allocated on the basis of patronage, and so this is a key circular incentive within the system to generate additional use value, additional engagement and content among users by incentivizing it through profit-based allocation. So the more you use the co-op, the more you benefit from it. Next slide, please. In example number 2, we're getting back to some comments that Andrea made before the first example. In this example, it's substantially the same scenario, except we've inserted an intermediary, a private equity buyer that comes along with a pooled fund of capital. And TechCo in this case is growing rapidly, not yet profitable, but the founder doesn't want to exit. So again, we're dealing with a portfolio company. Maybe it's earlier stage than in Portco. In this case, it's not yet profitable but growing, but the founder doesn't want to exit, and or at least they don't want to exit in traditional terms. And so here we're talking about the kinds of private equity buyers that are yet to exist in a lot of cases, especially in the tech scene. So we're talking about pooled capital with a commitment, or at least a commitment, if not some experience with cooperatives, that negotiates with the founder to buy the enterprise, to buy the business. Again, if the business isn't profitable, it's growing, and the founder doesn't want to exit, we're dealing again with the scenario where the early stage investors are unlikely to see a conversion of their note or a buyout of their preferred equity. So in this case, the fund preferred would end up extending their note rather than seeing liquidity. And so some proposed steps in this circumstance would be that the private equity buyer negotiates a buyout of the business they would essentially pay out the fund. If it's a convertible note, they would get paid out at either the buyout valuation or the valuation cap, which provides them with liquidity perhaps sooner or in a value greater than they otherwise would. Private equity firm takes control, restructures with a goal toward balancing growth and profitability. But in this case, they have a strong commitment to cooperative ownership, and they embark on a plan to transition the business to user ownership. So they're building the essential structure, foundation, and channels of engagement to do that. And they recoup their investment through that transition through profitability. So as the business transitions from high growth to profitability, they can essentially recoup some of their investment through the operating cash flows of the business in a non-extractive fashion, turning over control on a more methodical way and on a slightly longer time frame to user ownership. And in this case, the resulting entity can operate either on a buy-in scenario or on an earn-in, but we'd likely insert some sort of poison pill or profitable sale prevention measures so that the entity truly exists in perpetuity as a user-owned enterprise. Example 3, we inserted to give some context and to highlight some potential terms of an early stage deal even prior to the investment opportunities that might exist in examples 1 and 2. And this term sheet, if you will, is adapted from an interesting model put out by Indie VC. Their term sheet is essentially open source. It's on GitHub. It's online. You can go to Indie VC and learn more. But they've taken, I think, a fairly progressive view in early stage investing, and the model fits quite well in looking at potential investment in a startup that's organized as a cooperative or a startup that might eventually seek to become owned by its stakeholders. And the reason I believe this is because we're looking at an investment model that relies on operating income rather than on taking distributions out of the necessary cash flows of the business or siphoning off value from users. So in the Indie VC scenario, an investor makes an investment on an unpriced basis in an instrument that looks a little bit like a convertible note. The difference here is that there's a flexible line of credit in exchange for a fixed amount of equity. So in this case, the investor gets 10% equity in the form of preferred stock whenever that preferred stock is issued. So again, somewhat like a convertible note, a little bit like an instrument called a SAFE, if you've heard of it. And the way the investor reaps return is through discretionary cash distributions. So again, unlike the scenario where the investor is paid off only in the event of liquidity, this is a case where the investor is able to recoup return during the course of growth and achieving profitability. Through discretionary cash distributions and profit sharing, the investment is capped, and this is flexible. You can decide on, agree to whatever cap is appropriate. Here it's a 3x cap, and there's a caveat that if the cap is reached sooner, the upfront investment essentially takes a haircut on the amount of equity that they are entitled to when the financing, or if the financing takes place later on. So in this case, you see that there's no need for an exit or an additional financing for an investor to see a return on that investment. And we believe that this model can lay the groundwork for a more sustainable, ethical, and regenerative tech startup, as well as be used as an instrument directly for a tech co-op if it's starting that way from the very beginning. Nathan, back to you.
Great, and fantastic. So those are some of the details of what we're thinking about, but I think a really key piece of the argument here is that there is value to be unlocked here, and I think it's worth looking at a few examples. And this is really important for making the case to someone like the private equity firm that might be interested in committing to a co-op model, and emphasizing that this kind of model would have unique value propositions that we need to consider. And so we'll look at a few examples that help inform this reasoning, as well as some examples of conversions. And we'll start with the latter. This is one that here in Boulder that Jason has been involved in. Do you want to say a bit about the relevance of this case here? It's a worker cooperative solar installation and utility company.
Yeah, so in North Boulder, Namaste Solar, while not a tech company, it's an example of a successful worker-owner buyout. We restructured the business and essentially bought back the business on a cooperative basis. It was one of the early examples that's now pointed to as a success case, demonstrating that cooperative conversions were a potential source of business succession planning and became a use case in looking at how capital can be deployed and used in a sustainable and non-extractive fashion. And so it's viewed as a success story for a cooperative conversion, although at the periphery of the tech economy that we're talking about today.
And I think one thing that's really powerful about this example is it was started as a partnership, right? I mean, it was started fairly conventionally. The founders actually didn't know about cooperatives when they started it, and I think that model is really appropriate for a lot of tech startups to begin not as a cooperative when you have, but for the founders to take on the risk for themselves, and then to maybe shift to a more cooperative model once they have established a user base. In many cases, it doesn't make sense to begin cooperatively because you're still developing and proving the concept in the early months or years, and so it really makes sense to plan for conversion rather than to imagine that a cooperative model will make sense at the beginning. One example of a cooperative startup is Stocksy United, which I mentioned earlier, and this demonstrates, I think, a few principles. One of the things that enabled Stocksy to get going was that it was founded by executives who had been part of existing dominant platforms in the stock photo space, and so they were bringing both their experience and also capital. They benefited from a buyout of iStock, and so they were able to invest $1 million loan into Stocksy United, which was then paid back within, I believe, a couple of years. And they were very successful and correct in recognizing that the cooperative model in their sector would be very competitive. They were actually able to outcompete much larger companies in a highly competitive market because through co-ownership, they were able to get the highest quality work and the best photographers. And so that was a case where they banked on the added value that cooperatives might contribute.
Inching us closer to a direct analogy, Dojo4 is a tech services agency, again here in Boulder, that just within the last 6 or 8 weeks converted from its partnership startup structure to a worker cooperative, essentially leveraging their integrity brand as a B Corp certified tech services agency to preserve their flexibility, allow them to grow, and to kind of boost their brand. And they really embraced the process, and interesting to see the conversations that took place during that conversion process and thinking about not just the services that they offer, but the way that technology can be developed as a product and the way that data and technology ownership plays into and intersects with the cooperative model. While still primarily a services agency, Dojo4 is another successful example of a cooperative conversion to enable scale while remaining true to the underlying values and integrity that makes them successful, but also an example where technology services often bleeds over into product development, and the way that a cooperative develops and owns the technology IP is a really interesting case.
Another case that informs this thinking is Associated Press, which began as a cooperative in the 1840s, but demonstrates the capacity of this model to operate at scale as a media utility. This is relevant to thinking about some of the larger platforms that we might consider. And another feature of the AP model is that, unlike a lot of, say Stocksy, which is owned by individuals who participate in the company, Associated Press is a cooperative of media companies. So this presents another opportunity, especially for that Model 1, where the users of the platform may actually have the capacity to help capitalize it. So maybe rather than having a bunch of individual members be the owners of and the members of the cooperative, it could be institutional owners and members.
Another example is maybe an unlikely one, looking at the agriculture sector, where cooperatives have been really instrumental in maintaining, preserving small family farm sovereignty. There's one of the largest co-op operations in the U.S. is called CHF. They're a Fortune 100 ag services co-op with hundreds, if not thousands, of members throughout the country. And similar to AP, in this case, we're looking at membership comprised of independent farm operations. And CHF itself operates as both a marketing cooperative and as a commodity processing and distribution platform, enabling individual farm operations to bring their commodities to market and achieve price parity or at least the fair treatment that one might get using a conglomerate system like Monsanto, ConAgra, one of the others. But interestingly, in this case, CHS, as essentially a utility of farmers, created a tech platform to enable its farmers to optimize their yield through GIS mapping and through data input system that the farmers can use at their own location, inputting and analyzing the data. And what's so interesting in this case is that the underlying IP of the system, as well as the data value contributed by farmers, is funneled into a system that's collectively owned by, for, and of the farmers. There's really no risk that the data is going to be extracted for advertising value, or that the platform will one day be leveraged for a Wall Street buyout. But in this case, the data truly is used to maximize the value to the farmer owners. And with the accompaniment of CHS operating at scale, this becomes a more viable proposition, whereas an individual or even a small set of farmers likely couldn't afford to develop the technology on their own. And as I said, CHS is a substantial competitor in the ag commodities business. Colorado's home to a good number of those members, and the technology has really been instrumental in making the farmers successful and bringing their operations into the 21st century.
And then a final example, which I mentioned earlier, is Twitter. And this is a bit of an outlying one, but it's been taken surprisingly seriously. I proposed in an article in The Guardian last September that maybe rather than Google or Salesforce or Disney buying the company, users should. And one of the first people to affirm this idea and to say he would buy in and support this was Albert Wenger of Union Square Ventures. And just this Monday, he posted a blog post explaining some of his reasons for supporting the shareholder proposal that we've we've put forward. And that proposal is quite modest. It's just suggesting not that Twitter immediately converts to user ownership, but simply that it study the options. And that's really in keeping with what we're encouraging here and what we're offering in this presentation, which is just an invitation into the conversation about what these kinds of models might look like. And you know, we've been surprised to see how publications from the Financial Times repeatedly to Vanity Fair have been taking this idea seriously and getting people thinking about some of the nuts and bolts of cooperative transition in ways that they otherwise haven't so far. So we want to end just by reiterating our ambition to build pathways for entrepreneurs and investors to embrace these cooperative models and to in turn create a fairer internet for everyone. And so we're kind of looking for your help to figure out how we can graft some of these models into the existing deal flows of the tech economy and create some better options. Jason, do you want to wrap us up here?
Yeah, so, you know, we're looking for a conversation to emerge. We're looking for feedback and input. You know, we think that there's an opportunity, and we think that there's a way to unlock value and provide a triple win. And so, you know, we leave you with these questions for anyone on the phone who's not able to see. You know, we're looking at who should be involved in this work, what barriers exist to deploying the capital needed to create a viable alternative to monopoly control and concentration of technology in our day-to-day lives. How do we identify and vet deals? I think this is a really important question about building a pipeline. And if you're listening and are interested, what role might you play? We're interested in, again, starting a conversation and learning from the experiences that you've had. So I think with that, we will wrap up the content and open it up for question and discussion.
Great. Thank you very much, Jason and Nathan. It was fantastic. A few questions have already come in, and I'll turn to those in a second. But let me see. We should have Brendan Martin on the line from the Working World. Brendan, are you on?
Yes, I am. And hey, guys, how you doing? Great job, the presentation. Sorry, I'm a surprise guest.
Good to have you on.
Good to have you here, Brendan. So yeah, just wanted to see how you see all this fitting with what the Working World has been doing, and especially some of the opportunities to combine it with an earlier question from some of the investors on the line around whether there is a concrete pipeline now where this could be experimented with. What have you seen in your work, Brendan?
Sure, I'll try to answer that succinctly. So just, you know, so the Working World, we make investments into Worker and other kinds of community-owned businesses, and have been doing that in many ways with the eye of being like a lab to help blaze a trail for plausible investments for investors to come in and pick it up at scale. So that's sort of part of our mission. And the possibility of these kind of tech platform cooperatives is one of those. You know, we make, you know, investor, obviously, you know, if you're an impact investor, you might think, okay, it's okay, we could share some returns, but obviously in an overheated market like tech investments, you might wonder, like, what is the chance of getting the kind of investments at the scale you need to compete there? There's a very strong argument that I'll point out for the theoreticals underpinning platform cooperatives. Most of the challenges that they face, it's certainly not in building an app. It's really on all the participants in the app. That is their biggest expenditure. It's in Uber, it's all the legal and marketing battles they have to fight because the taxi drivers aren't part owners. They wouldn't have the different governments in the world fighting them if they did have all the local people as owners. In Twitter, it's having to spend a couple $2 billion to buy a 8-employee company named Instagram because you're afraid that your customers might just suddenly leave. And the risk they face is that they are trying to extract the maximum possible from the different users of their platform. So then they also face the risk of what those users do, and they have to actually spend most of their money controlling for that. So while if you said, okay, we're going to start some parallel thing or buy out one of these platforms and make its users cooperatively own it, then, well, that just means we're going to have to give up some of our return for those users, and is that going to be scalable in the size of the tech world? We'd argue is that you are giving up some return, and some of that might be impact motivated for all the reasons that the guys just laid out really well. And but it's also a question of lowering your risk. So rather than thinking only 1 out of 100 of these crazy tech projects is going to work out, and too bad we just gave them $10 million to a bunch of millennials to operate a cool looking office for a while and then go out of business. When there is actual engagement from the platform users, your failure rate and costs can go way down. So the argument is that this is a way for capital to get less returns, but also at a lower risk, so still not necessarily losing from a market perspective. That's it. And it's also very plausible that as certain parts of the tech world mature, and there's not such constant disruption of these online platforms, that would be the most stable direction for them to take. Again, Facebook is constantly worried about becoming obsolete, and all you need is one next social media app to make a multi-billion-dollar company face trouble, and they're constantly trying to stave that off. Whereas if their owners are, if their users are part owners, it would be very different. So that might be a mature place for something like Facebook to park itself. For something like Twitter to park itself is in distributed ownership. And that's the best way to guarantee the long-term value of the underlying asset. So just a little market-based pitch for why we think that distributed ownership isn't just a nice idea. It's possibly a very sound one for keeping the asset value high, for lowering losses, and for making sound, stable investments that still allow profit to be shared. So we've worked with some platforms like this. There was a platform we were working with for it's a type of community-based, kind of community-supported agriculture, except they were very cleverly not just giving you the same head of lettuce every day for a month, because they sourced from many farms rather than one. And they got their customers online and did the sourcing online. There was a lot of tech backend for this process. And there was a tension between the brick and mortar packing space, which was very community tied and had these people coming in to pick up their boxes or get them delivered, and understood that it was a community project. And then the tech backend, which was not connected to the brick and mortar things, which wants to imagine all that brick and mortar and labor-based stuff as being as streamlined, as commodified, and as uncommunity related as possible, sort of in an Amazon warehouse kind of way. And that just didn't work that well for these community-based distribution points that were trying to connect to the local farmers and trying to connect the local community to sell their goods. So that tension, we were looking at trying to resolve by having those local, so city-based or neighborhood-based points of packaging and distribution be actually owned by the workers in them. And there was some model looking at then even offering a second class of membership for the consumers of this sort of high-end CSA or new wave CSA kind of thing, and then have the tech platform be used in multiple cities and multiple places, and that possibly being then owned by the members being the local-based CSAs all owning together the tech backends, which then could be invested in directly just for the tech part, because the investments look so different, and someone who's interested in a tech investment has trouble with the brick and mortar side and vice versa. So that's a project which it's not investable at the moment, but it's the kind of thing we've seen emerging. We don't have a tech platform you could invest in tomorrow, but we probably will in the next year or so if like the work that the guys online are doing that help explain how there is a market for this starts to pick up. I'll end it there. We could talk a bit more. I could try to bring up some other examples, but I think that's pretty good for now.
Yeah, and just in terms of a couple other, thank you so much, Brendan. A couple other examples in terms of pipelines. that could be considered. One is kind of one-off examples like Josephine, which did an earlier presentation, and which has been constrained in its ability to share ownership, which the founders really want to do because of its investment history. And if we were able to step in and create an upside for the early investors, those options might expand. Another strategy is looking at something like open collectives, which is a new platform that's kind of building an economic layer on open source communities. And so this really, for a kind of startup model, enabling open source communities to organize cooperatively as kind of a quick way to get going is something that I've been looking at quite a bit as well. And but I think mainly what we're trying to target here are the companies that aren't already advertising their interest in open and cooperative models, but may actually be really excellent candidates. So we're trying to kind of find our way into the mainstream accelerators and incubators and be able to start asking questions. And I've found that for instance, when I do seminars or kind of counseling and mentoring with startups, that once you start the conversation with them, they get really excited about these options, and some really creative ideas start coming up. But for most of them, they're not even seeing the question get raised.
And I'll add a third kind of leg to the strategy, which is for folks who have been to pitch events for some of the big tech accelerators, you can kind of spot which of those pitching companies is a good candidate. And what essentially gave rise to some of these ideas was talking to folks at one of the big local tech accelerators, Techstars. And it struck me that they're constantly building new portfolios and looking for the next lottery play, only to disregard their existing pipeline. And so I think there's a place for an alternative version of shareholder activism in becoming an LP, a limited partner in some of these funds, to begin a dialogue and a relationship with the fund managers to think about what of their existing portfolios might be, a good exit candidate in this manner, and what sorts of new verticals is the accelerator going where they can take a fresher approach. But we see the existing pipelines through the accelerator and incubator networks as part of our target, and really part of the way that we can strategically start to roll some use cases out of the existing ecosystem without having to create new models from whole cloth, which has its benefits, but certainly also its inefficiencies and costs.
Great, fantastic. Thank you, Jason. Thank you, Nathan, and thanks, Brendan, for jumping in. So let's see if there are any questions on the line. If you'd like, feel free to unmute yourself, and if not, I will unmute you on this end if you are on the phone. Bruce, if you're dialed in from the phone, I'll try to unmute you there in case you had any views on this. The part that we're especially interested in looking at now is the piece around the feasibility. So maybe, Bruce, since you sit both on both sides, working both on the investor side and on the entrepreneur side, oftentimes, how do you see this playing out in practice? And do you think there is a concrete pipeline that some of the members of our investor network could start exploring? I'm going to start unmuting people as I try to discover which one is Bruce in hiding.
Huh.
Are you there?
Andrea, this is David Berg. I do have a question, but I'll wait till you find Bruce.
Well, why don't you jump in meanwhile?
Great. Yeah, I didn't have luck with the WebNX program. Sorry, so I've been following along by phone. One question and two comments. The comments, I guess, is that as I look at the deals that we've reviewed over the last couple of years, I think you guys have, you've latched on a couple of different issues that are really interesting but are not necessarily all related to the co-op issue. So when I look at Model 1, kind of assuming, positive cash flow, that sort of thing, I think you've narrowed down to, like, are there secondary market opportunities for venture fund deals? And I think there's a yes on that for sure, but you could say that whether it's a nonprofit buyout or whether it's a co-op buyout, but definitely there's some deals out there in that space. I think likewise on the capped return issue, you can say there's opportunities to structure a capped return or a discounted buyback. I think there's some deal opportunities out there in that space. But I would be really curious to hear a couple of comments, I guess, on, as you look specifically at the co-op side, how do you deal with the follow-on capital issue? Because a lot of these deals are much easier if you're on the spectrum that are not super capital intensive, but those that need the B, C, and D round get a little more complex in terms of how you structure it in the co-op space. And then the second question being, be super interested to hear more about, I think I like that Brendan used the term distributed ownership, because we look at a lot of deals that are partially worker-owned that still allow for conventional capital on the outside and conventional exits in some place, but share the exits. So have you looked at those models as well? Thanks.
This is Jason. I'll try to tackle those. Those are great comments, very, very insightful and wonderful questions. I'll tackle your last question first, which is to say, yes, I do a lot of work along the spectrum. In fact, you noted that there's a spectrum in this practice, and there really is. I work along that spectrum of employee ownership, from small, partially employee-owned businesses that do seek outside funding for capital-intensive businesses, all the way to 100% worker cooperatives. And I think we need to remain open and flexible and avoid the dogma that often comes with worker ownership or stakeholder ownership models. And I think that's why we're looking at this as a strategic play to say, is there an opportunity that we can begin to kind of play around with and then experiment on and learn from. So I think that spectrum allows us some more options. Unfortunately, that doesn't clarify the picture very much. We'll likely not have a single standard bearer when it comes to a term sheet, but we'll have a variety of indicia of companies and deals that we can begin to just kind of rely on that awareness and then start to ask different questions. I have done work with, to answer your first question, I have done work with businesses that are stakeholder-owned, that are capital-intensive and have had to go after later round financing. And many of the new structures or new cooperative structures enable that financing to come into the fray. So while a later round investment might not be possible on a target dividend basis using the target dividend scenario, there are other models out there that allow for profit-based allocations and asset sale allocations as well. And some of those forms allow for voting rights of investors. They're essentially a hybrid model between a traditional cooperative and an LLC. And that model here in Colorado and a few other jurisdictions is known as the Limited Cooperative Association. And I've used that form for ventures that are likely to need subsequent financing. They haven't yet gone that route, but they are set up to do so. And the case to make to investors is really just a business case at that point. But the economics are quite flexible, and I think the rate of return can be substantially greater than what's otherwise available with kind of a 5 or 7% capital-based return.
Thank you, Jason. I think Bruce, if you're on now.
Sure, thanks, Andrea. Yeah, just two thoughts I had on, I think feasibility is an important question, and I had two thoughts, one from the investor side and one from the enterprise side. On the investor side, I think it's just part of the challenge is finding investors who are willing to make investments that aren't going to have the sort of return profile that would be typical of a private equity type of investment. So I think usually when investors think about investing in tech or doing direct private equity investments in that industry, they're looking for the home run type of return. And I still see, even in impact investing circles, a lot of resistance to thinking differently about what is an appropriate return in an earlier stage context, or if it's a mature company. Because I know we also saw the model of investing in a mature company that had cash flow. For some reason that type of investment doesn't seem to interest a lot of the investors that I'm talking to. If they're looking for more predictable, maybe a fixed income type of return, they seem to want to do that in conventional ways. And again, if they're going to get involved in private equity type of investing, they seem to be looking most often for kind of a typical type of risk-adjusted return profile. So I think one is just finding investors who are willing to think differently about these investments and think differently about return. On the enterprise side, I think one very practical problem is, I think maybe especially in tech, is finding the tech entrepreneurs who are willing to be involved in this kind of very democratic, egalitarian kind of structure. It seems to me that, of course, the model that is set in conventional tech is, founders are kind of like gods, and they should have these super voting provisions that maintain control, sometimes into death, literally. And I see that even with more progressive, maybe some of the more progressive technology companies that aren't public, but could be trending that way. Progressive in that they might be sort of by B corporations or even benefit corporations, but my sense is there's still an inclination among the founders to want to maintain voting control or maintain majority control over the organization. So there's this real kind of, and I to a much smaller extent saw that even with myself and for example, talking to the founder of Dojo 4, when we're thinking about our conversions, thinking about as founders that, not only are these organizations, not only are we giving up control, but we're also changing the economic dynamics in a very fundamental and dramatic way. I mean, we're essentially saying we're not going to be as a worker co-op, our distributions, our economic participation is not based on a historical investment that we may have made in sweat equity or even capital investment, but it's based on our current performance, our current contribution to the business, and it's measured in accordance to a formula that's the same as our other partners or coworkers. So it is this huge shift in thinking from sort of the hero, super person entrepreneur who should be at the front, both in terms of economic reward and control of the organization, to really saying, I'm just one of many, and I'm going to be working along these very cooperative, egalitarian principles.
But I think it's an important issue to raise. Though I think it's also important to recognize that there can be flexibility in how these models might form on a governance side as well. And I would point back to the example of Stocksy United for this, which is a platform that recognizes the need for a very agile and flexible governance structure, and they've reflected that in their ownership model as well as just in the day-to-day governance. So they're able to operate in many respects as a as any other tech company of its size does, with considerable authority vested in the CEO, Brianna Wetlaufer. There's a lot of ongoing engagement with the user community, but as any other platform has to do. But a lot of the control is hers and her team's. And then also they've reserved special powers for what they call advisors, which are really mainly founders. So they have a separate class in their multi-stakeholder structure that allows for preserving some element of founder control that I think ends up being kind of comparable to what a founder might expect to retain in the case of investor ownership. And I think really the choice can be phrased less as one of between retaining control and giving it away to users, as it is being retaining a similar degree of control as a lot of these platforms founders have to give up anyway for financing purposes, but having a different alignment. And you pointed to that, Bruce, in your example, that having a business model that is aligned toward user interests rather than investor returns primarily.
And I wanted to remark, maybe in a short comment, I'm seeing a convergence really of investor and entrepreneur interests in three respects. One is that I create, in about half of the cooperatives that I form, I create a special founder class of interest to recognize and at least partially reward the initial risk that an entrepreneur takes and the sweat equity that he or she puts in, and differentiate it from that of a later entering member or worker. So that's in about half the deals I do. The second comment is that some of the more flexible cooperative structures will allow for a balance of investor and member interests when it comes to liquidity. So it's not to say that 0% of these options are ever going to provide a home run opportunity. It's just that that may not be the ostensible and decided exit for the enterprise. And to reflect that, I've talked to several of you about the notion of a poison pill that strips away residual positive proceeds from a liquidity event and kind of redirects it to a charitable endeavor or philanthropic effort, or one that supports a cause. But in another case recently, we took essentially a formula that equitably divided up the liquidity value of the enterprise between the investors and the users. And so we have the flexibility to design what the exit looks like if it comes to that. The last comment I'll make is that 90% of the startup co-ops I work on are being founded by people who have been through one or more traditional startup cycles, supported by venture capital, and having founded a traditional business, very often in tech, particularly some of the younger entrepreneurs. And they've made their way often after a bad experience with an exit or a bad experience with the traditional method of raising capital to come to the cooperative and find it as a humane, while completely restructured model for a business. They're converts. And it's just it's an interesting anecdote, but I thought I'd mention it because it's just such an overwhelming experience and quite a frequent one that I have.
Great, thank you. And I will note that David Berg from Underdog, who spoke earlier, has been one of the pioneers in the idea of having the exit into a nonprofit type of structure, having that mixed type of ownership there. So I would definitely refer to Underdog as a resource on that. So one thing that comes up, including with Bruce's comment earlier on the interest of impact investors, very interestingly for me, at the intersection of the ownership piece and the governance piece, it seems like these areas starting to attract a lot of more conventional investors too. And we were looking at it in the case of the recent Snap IPO, the parent company of Snapchat, that essentially strips away all sorts of governance rights, that's created meaningful backlash on the part of investors that are that are used to having, one share, one vote, and trying to reconcile, which is something that we'll be exploring soon, this idea of how you can have the right amount of governance in the sense of looking favorably at entities such as the New York Times, where they have the dual class share in order to preserve the mission, which keeps at bay some of the, especially the activist investors that could be impinging on that mission piece, with something like Snap, where you have zero investor voice essentially and zero potential for shareholder advocacy and shareholder resolution. So I think that even moving outside of the pure play impact investors, there is a group of folks, even at the big pension fund level, that are looking more at what it means for the governance to be going the way that it's going, both with current SEC actions on shareholder voice and shareholder power, and again with companies getting away in the public markets with doing an IPO like Snap just did. Now, even from the comments that came through, Jason and Nathan, and the same folks that have been looking at Josephine recently. So I would encourage you, as potential deals come up to be explored within these structures, to definitely bring them up with this group, because I think that there are folks chomping at the bit, if that's the right expression, and just trying to see, if we can turn quickly this from a very cool, somewhat theoretical model into something that they can start putting some money in and see how that plays out. And with that, let me check and see if there were any other questions that that we had missed here. So there were some questions that came in around governance and potential conflicts of interest between the stakeholders, and I imagine with the ownership piece. I hadn't thought particularly about the conflict of interest, because I always say it, to use Morgan Simon's phrase, more as a confluence of interest when you have this stakeholder alignment. But Jason, Nathan, is there anything that you wanted to remark on that? Do you see any kind of potential conflict? And I mean, you know what my opinion is, that the conflict is really when the shareholders that call the shots for drivers, cooks, and everybody else. But
well, I think it just points to the need for appropriate ownership design, to use Marjorie Kelly's phrase, and to really think carefully about what is the appropriate model for a given business. For instance, if Facebook users were to become owners today, and they had no real significant skin in the game, it was just kind of handed to them, I think there would be significant conflict of interest, because suddenly they'd realize, hey, we're being watched and our data is being sold, and they know way more about us than we really realized, and so they would kind of mothball the business, and that would be a big problem. And so maybe that's the kind of scenario that we're considering here. But I think if you design a business where the stakeholdership actually feeds the value that the business is creating, then it makes a lot of sense. And I think I would emphasize the fact that when we talk about platform co-ops, I think we have to not just think about co-op versions of existing companies. If you look at the nature of the cooperative movement around the world today, it tends to cluster in certain sectors. It tends to also cluster in sectors that investor-owned businesses tend to not do so well in or not be interested in. And so I think we also want to identify not just replacements of existing companies, but competitive, but sectors where cooperation can be a competitive advantage. And Associated Press is an example of that, where over the years, for the century and a half of the company's existence, a number of investor-owned competitors have arisen, and they've generally fallen because this model just works very, very well in that sector. And so you know, we want to look for the sweet spots where the cooperative model can enable alignments that otherwise wouldn't work out. And you know, another example I might add is for social media. One thing that we're seeing right now is the emergence of a new open source alternative to Twitter called Mastodon, and it's built on a model of federated, distributed server nodes rather than one central version. And this is a very you know, co-op compatible model. It works very well for a kind of federated network of cooperatives using the same software. But it would work really badly for a centralized company. Actually, Twitter considered integrating that technology into the company very early on, but the investors said no because it just didn't work for their business model. So I think there are actually a lot of potential opportunities for where the technology is already there for developing new kinds of platform businesses. The problem is the business models aligned to that technology aren't there, and there may be some situations where cooperatives could be a point of intervention for providing that business model.
Great. We have a so let me turn to Yuli Mazinovsky, who had a question, and then we can turn it back to Jason for his comments.
Hi. Thanks, you guys. This is a very, to me, a very informative presentation. Certainly not my daily life. I was drawn to it for the media aspect of the headline. I work in entertainment, have done traditional entertainment, Hollywood, really movies, TV, and very soon commercial advertising production. And I wanted to just open this question in a loose way because to me there seems like a rather large disconnect in the theoretical to the practical. I think much of what's missing here on my end in terms of building companies and attracting what's the word I'm looking for? Attracting investors is that investors don't see traditional businesses. Sorry, so much of this discussion was centered on tech, but in entertainment, which is a very mature business, rates of return are much smaller and are to be accrued over long time horizons. As soon as if I'm raising money or looking for money from folks, you tell people, oh, I get a 4% return a year. It's the snooze button is hit if they're not interested. And I think part of that is, can you talk about investor culture? And maybe this is just American investor culture. They're the sort of, the Mittelstand idea, which was popular a year or two ago in the press. But to what extent can investors be reconditioned to accept that it's okay to grow something slowly and steadily, whether through, co-operativism or simply responsibly managed businesses? And that's the kind of work typically entertainment has done and has profited from. What can be made appealing to investors with that sort of model? I mean, I think that's also to me a big issue on the media, the quote unquote pure media side of things. Is this clear?
Thanks, Yuli.
I think that question is probably best for you, Andrea, or somebody kind of in the finance business.
Well, I can address it very, very quickly in terms of, yes, I agree that most of what is needed here is this change of mentality on the part of the investors, and I think that is happening naturally. In part, that's why I was focusing on the concrete examples, right? Because to the extent that we have an emerging group of investors that are keen to do slow and steady growth, that understand that not everything needs to look like a unicorn, we want to be able to provide some good early proof of concept so they can start sinking their teeth into it. And I would encourage anybody, again, that has a model of that sort to bring it up with us to see if we can use it as something that could then be used to further this change of mindset on the part of the investor. So it's a two-way street, as Jason was saying earlier. The two areas are coalescing around these alternative models. There's a lot of money that we see flowing into media now, perhaps not the pure play media type, Yuli, that you were talking about, but with the current political climate, we've seen a resurgence of investor interest in democratic media, let's call it that way. So this might be a good moment to start jumping on that and saying, let's not only fund different media, let's fund media differently in ways that actually build in the type of structures that we would like to see.
Can I just emphasize one other thing?
Please.
I think what we're trying to get at is a situation where we don't have to re-educate the whole financial sector. Part of what I would love to see happen is to create a kind of bridge between existing capital and co-op finance, right? Like, CoBank down the road from me in Denver, a big cooperative bank that finances power plants for, big electric cooperatives, right? $128 billion enterprise, and figure out bridges to get them involved as the capital providers into the into something like the platform economy. So I think, to me, the challenge is not that you need to re-educate the tech investors. The challenge is to figure out a package so that you can kind of get the tech investors out of the way and shift some of this stuff over to models that are more kind of naturally patient, and to recognize that, as with that sector of electric cooperatives, right, when the need arose, the financing mechanisms arose as well. And I have a great deal of confidence in that, as we start proving some of these models in certain cases, the financing will emerge. We've already started to see companies like, financiers like Purpose Capital start to emerge that are expressly designed for supporting platform co-op like tech businesses. I think as the viable businesses emerge, so will the larger scale capital.
Yeah, no, I agree with that, Nathan, in principle. We have seen a few instances where what was needed was precisely that aligned capital that could be used to clean up the cap table and displace traditional early stage tech investors that were no longer in sync with the aspirations of the company. And in some cases, it was hard to find the capital. In some cases, it was still hard to find the capital and the correct structure that the investors could wrap their head around, and that would make sense in terms of getting the tech investors out and kind of have a fresh start for the company. I'm sorry that we went a little bit over the hour and a half, but clearly there's a lot of interest in this area. One last thing that came up from your mentions and kind of reconciling this with this piece of changing the investor mentality is this idea of considering tech platforms as a public utility. And we've had a conversation around the role of banks and how banks, especially at the regional level, such as New Resource Bank and Beneficial State Bank that presented recently, really view their role as a utility. And I was wondering, Nathan or Jason, if you can quickly comment on that, on how you are looking at this kind of public utility role for a platform.
Maybe I'll take first stab because I want to draw a distinction in the discussion between the utility model, which I think really relates to scale technology and the emergence of models that have been successful at monetizing, aggregating, monetizing, manipulating data, and have actually kind of, as a sign of maturation, become primary buyers in the tech space. With those of the early fledgling stage tech ventures that we're seeing. So I think we need to draw a distinction between, on the spectrum of growth and the various instruments and strategies that we deploy. I won't say much. I'll leave it to Nathan to talk about technology and utility design. But for me, the real interest in this discussion is to avoid such a concentration in the first place. I think early philosophy of the internet involved a high degree of democratization and access, and I think that relies on an open access to the basic underlying structure of the internet and requires there to be a healthy biodynamic ecosystem of technology in the marketplace. So I don't know that this discussion needs to relate. It can, and certainly it's interesting to relate it to scale, but it's more interesting to me to see instances of traditional technology grown to a scale that maximizes use value, not transaction value, and manifests its ultimate kind of parked structure, as I think Brendan called it, using a user-owned model. I mean, I see that most applicable in the small to kind of early growth stage of a company before it ever becomes a fish that's about to get gobbled up by a shark.
Yeah. Well, let me clarify, Jason. In that comment about public utility, I was hinting at something that perhaps, lawyer to lawyer, we can say is more along the lines of a common carrier type of idea, right? Is there a duty that accrues to certain tech platforms, very much by virtue of the kind of public-facing and service that they would provide? So less on the scale and more on this intrinsic common carrier type of role that they might be playing.
Well, I think that's a relevant question, and it's something that could come up. I think especially as this sector matures in some serious ways. It's striking to see, for instance, an op-ed in the New York Times over the weekend arguing for breaking up Google, and there's a kind of insurgency in Washington going on right now around trying to kind of rejuvenate some antitrust principles. That this is something in the common carrier conversation that we're seeing too with the broadband providers and the FCC's discussion. It may be that some of these companies might find themselves in a regulatory situation, both in the U.S. and around the world, where regulators start perceiving them in this way, and they have they find themselves facing a patchwork of regulations that could become quite expensive. And historically, there are some examples, such as electric cooperatives, where cooperative business models have been a way of bypassing that kind of regulation through a rationale of self-regulation. And that I think is it's a case that we're not making now because it's not a reality right now. These monopolies are not being treated as such in the U.S., though that's less the case in Europe. But it may be that there's even more incentive in the future for these kinds of cooperative models as an alternative to a very costly patchwork of regulation.
Great, thank you very much. I think we'll need to close now. And thanks to everybody for attending. And if you're interested in hearing more about the work of the Transform Finance Investor Network, you can contact me. It's Andrea, A-N-D-R-E-A, @transformfinance.org. And if you want to get in touch with Nathan or Jason, their emails are here. If you're calling us on the phone, it's nathan.schneider@colorado.edu and jason@jrweiner, that's WIENER.com. Thank you, Jason. Thanks, Nathan, for joining us. Clearly, there's a lot of interest in this, and I look forward to being in touch. I saw that there are some comments from some of our investor members that we can pass on to you offline as well on the models themselves.
Thanks to you and everybody for joining in today.
Terrific. See you next time.